Namaste, Ola, Marhaba. I'd like to welcome you all to this live webinar by Page 360. We are indeed grateful to all our participants joining us from across the globe for taking out time to attend this webinar. My name is Kanika Miglani, and I'm the Head of Marketing and Client Relations at Page 360. And today I have with me Mr. Amit Goyal, who is the co-founder and Chief Global Strategist at Page 360. He co-founded Pace Group in 1995 and has focused his energies on researching global asset classes and financial markets since then. He has been keenly involved in advising large corporate houses and family offices on their asset allocation strategies. His articles and newsletters on financial markets and spirituality are very well known. Amit is also a familiar figure on TV, where he has appeared on various business channels for his views on global financial markets. Today's webinar is an endeavor by us to present you with credible and promising strategies to navigate through this very dynamic global landscape. We will be particularly focusing on how the global economic and financial landscape may evolve over the rest of the current decade and how investors should position themselves to take advantage of this evolving scenario. To make the session interactive, we shall open the question and answer session right after Amit's presentation. So continue to post your questions to us. To send a question, please use the Q&A panel, which is right on the left-hand side of your screen. Just type the question, your name, location, and click on the submit button to share your question with us. I would now like to request Amit to take us through this very exciting economic and financial journey of the 2020s.
Thanks, Kanika. From different parts of the world. We are indeed grateful to you for giving us the opportunity to have this live interaction with you. So financial markets and global economy are today at a crossroad. So as we all know, last 1.5 years has been quite spectacular for the financial markets as well as the global economy. Equity indices from multi-year lows in March 2020 are at or very close to their all-time highs. Commodity prices have gone up by like 200, 300, 400% in the last 1.5 years across the board. Emerging market assets have done very well. So all risk assets have done extremely well in the last 1.5 years. But today, problems abound. So the biggest issue that we are facing today in terms of financial markets is the historically high valuations. So on any metric, as far as stocks are concerned, if you look at price by earning, price by book, price by sales, we are at all-time highs. We are in uncharted territories, and we are at levels which in the past have sounded a big warning to financial market participants that probably this boom is about to come to an end. We've in fact crossed those stages and gone up even further in the last few months. Now, for the financial markets, apart from the valuations and apart from the fact that your valuations are extremely stretched and your price to earning and price to book are very high, apart from that, if you look at the earning revisions, now earning revisions have been the underpinning of this bull market for the last 1.5 years. By earning revisions, we mean to say the speed with which the analysts revise upwards the earning estimates of corporates for the coming quarters and coming year. Now, for the first time in last 1.5 years, earning revisions have stopped happening on the upside. So earning revisions have plateaued in the last couple of months, and they are no longer going up for the next quarters and for the next year. This is something which has happened for the first time in 1.5 years and is a very important warning sign to investors that the time ahead could be radically different from the time gone by. Similarly, if you talk about the global economy, taking advantage of the low base rates from the same time of last year when the world was effectively in a lockdown, growth rates look extremely healthy today. So for the year 21, the overall GDP rate for the whole world is probably going to be the highest in the last many decades. But again, there are issues which abound and which surround the global economy, and probably which make us believe that the next 1.5 years and the coming years may be very different from what we have seen in the recent past. The biggest factor is the monetary and the fiscal stimulus. So when last year, when the governments and the central banks of the world unleashed their monetary and fiscal stimulus, that was the single biggest reason why we had such a short recession and why we bounced back with a vengeance from that very, very short recession. But if you look at right now, the situation has changed. So from the huge fiscal largesse of last year, the fiscal stimulus has come down drastically this year. While we still have fiscal stimulus coming in from the governments, but this is much smaller than what it was last year, because of which we already have a huge drag on the GDP growth, which will reflect in the coming quarters. In fact, this GDP drag is probably one of the biggest GDP drag from fiscal stimulus factor in the last many, many decades. Apart from that, if you look at the monetary stimulus, many central banks of the world have already started taking up the interest rates. If you talk about US, then we are talking about tapering, which is going to begin in the next few months. So both fiscal and monetary stimulus, which was the bedrock of this economic boom that we have seen in the last 1.5 years, is not going to be so supportive for the global economy in the time to come. Apart from that, there are other issues as well. COVID is not dying out, and irrespective of the vaccinations and irrespective of so many things which have been done to basically encounter the situation, today COVID still presents a huge challenge for the global economy. Apart from COVID, you have supply disruptions, many of which are related to COVID. And apart from that, you've got inflation, which is at a multi-year high. And in some cases, for example, in US, inflation is at a multi-decade high. So the global economic landscape is today a lot more challenging than it has been in the recent past. So what you now see in front of you is how the MSCI World Index has done in the last 50 years. We have seen some stunning booms like the boom that you had in 80s, where MSCI World went up by more than 370% in a matter of 9 years. You've also seen some pretty stunning corrections. So the biggest three corrections were one which happened in the early 70s, then the one which happened post the 99 2000 tech boom, and the third one which happened when the global financial crisis started in the year 2008-9. So hopefully by the time we are done with this interaction, all of us should be in a far better position to understand where we stand today, how the landscape is going to evolve over the next 8 to 10 years, and what are the best financial strategies which one can employ to take advantage of this evolving financial and economic landscape. So essentially, the economic cycle can be divided into three different type of economic phases. You can have a boom phase where we are in right now and where we have been for most of the time in the last 11 to 12 years post the great financial crisis. So boom phase is characterized by historically high equity valuations like you have right now. You have rising debt levels, you have high commodity prices, you have low bond yield spreads and low risk premiums. Deflationary phase, which often follows a long boom phase, is characterized by falling risk assets values. It is characterized by a rise in government bonds and the falling government bond yields, rising risk premiums, rising high yield bond premiums and spreads, and tightening liquidity conditions. So post this boom phase, whenever this boom phase comes to an end, probably one can expect a deflationary phase, particularly because of the fact that huge amount of debt has been created in the last 11 to 12 years, which probably can become a huge catalyst for deflation over the next few years once this boom phase comes to an end. And then finally, you have hyperinflationary phases. We have seen very few hyperinflationary phases in the last 50 years. the only real hyperinflationary phase that happened was in the 70s, when post Nixon taking dollar off the gold standard. But this time we believe that post the deflationary phase, you could have a hyperinflationary phase because of the way money printing is going on in all parts of the world. So today, whenever you have an economic slowdown, the first reaction of all banks, all central banks and all governments is that let's print more money. Let's keep the printing presses rumbling to somehow avoid getting into a deeper slowdown. But it also has its downside, because if the money printing goes on incessantly, then eventually there could be a loss of confidence in the fiat currencies themselves, which many of us believe are being abused by these central bankers, and which is what we did last year. But we came out of that slowdown because of that. But eventually every good thing has to come to an end, and there would come a point when a deflationary phase is not followed by the next boom, but is followed by a hyperinflationary phase, which is characterized by double digit inflation figures, shrinking economy, so basically a stagflation, underperformance in equities, collapse in government bond prices because inflation is going up, hence the bond yields are also going up, and it is characterized by a sharp rise in precious metals and agricultural commodities. So this is where we are today. We are in the middle of an unprecedented boom phase, mostly unleashed by the monetary and fiscal stimulus that we have seen from the governments and the central banks in the last 1.5 years. So this current boom phase is characterized by historically low real assets compared to financial assets. So as you can see on your screen, real assets versus financial assets are at a century low. So it is at the lowest in the last 100 years. So even at the height of the tech boom of 99 2000, or the unprecedented boom that you had in the 1920s just before the Great Depression, this particular boom has taken things to yet another level which has been unprecedented and never before seen in the capitalistic history. So real assets like commodities, like real estate, which are not low by any standards, but because the rise in the financial assets has been so astronomical and so stunning, the real assets, even though they have also been in a bull run, but their bull run pales in insignificance compared to the rise in the financial assets. So, needless to say, when the boom gives way to a slowdown, a recession, or a depression, this thing changes. And because you see a much faster move down in the financial assets compared to the real assets, so this ratio moves up every time you have a recession or a depression. And whenever this particular boom phase will come to an end, you will again see the same thing happening this time around as well. So these are some of the returns of various asset classes over the last 10 years. As you can see, gold has been at negative 4% in the last 10 years. So this has been one of the worst asset classes over the last 10 to 11 years. Bonds have returned well because bond yields have been coming down, even in spite of the fact that we are in an unprecedented boom. The bond yields today are much lower in US and in most parts of the world compared to where we were in early 2010 and 11. So bonds have returned 36%, REITs have given 189%, S&P has given a stunning return of 360%, Nasdaq, which has been one of the best equity indices all over the world, has given a return of 660% plus. Google has gone up by almost 9 times, Apple by about 12 times, Microsoft has gone up by 13 times, Amazon has gone up by more than 15 times, Tesla has gone up by an astronomical 139 times, and Bitcoin has been the most stunning of them all. It has gone up by 4,600 plus percent over the last 10 years. Now, what is to be appreciated here is that Google, Apple, Microsoft, they were by no stretch of imagination, they were minnows 10 or 11 years back. They were gigantic corporations even 10 years back. But in spite of that, they have gone up by anything from 8 to 15 times in the last 10 years. That just shows you how unprecedented this boom has been. And it also shows you how technology and consumer discretionary space, basically the tech space, has been such a big beneficiary of this social media revolution, this e-commerce revolution, the smartphone revolution, which has unfolded over the last 10 to 13 years. So this is a 160-year chart which shows how many, this is basically the US scenario, and it shows how many working hours do you need, do you need to put in to buy 1 unit of S&P 500. And as you can see, after being range bound for almost 120 years, which means that income of US citizens and the wealth or the S&P 500, they were basically moving in lockstep for 120 years. But this changed 40 years back in 1980, and post that you can see that the incomes have gone up much less than the stock indices. So the wealth effect is much bigger right now than at any previous point in capitalistic history. You've got stock indices which have outperformed income. So now you need to, so anybody who's doing SIPs needs to now put in a lot more effort, needs to put in lot more income, monthly incomes into the market to get the same piece of market than what was needed at any point of time before. And particularly, this is at the highest in the last 40 years. And of course, broadly speaking, this has gone up a lot in the last 40 years, and it is at the highest ever. So as we can see from the chart, S&P 500 has taken full advantage of the fact that corporate earnings have been booming in the last 10-12 years post the great financial crisis. But actually, the stock indices have done much better than the earnings. So basically, stocks have gone up because the earnings went up, but stocks also went up because the valuations have gone up. So whether it is price to earning, price to book, price to sales, stocks have gone up and are richly valued against any metric and by any historical standards or comparison. We are at a point where the valuations are at an all-time high, which is why the stock indices have done so well. They have gone up as a multiplier of the earnings and the price to earning ratios, both of which have done extremely well and given this market the kind of boost that we have seen in last 10 to 12 years. So this is a question that we need to ask ourselves. Is this shaping up to be yet another tech bubble? So post the 99 2000, we have seen the highest percentage of the market, of the US market, coming from IT, communication, and consumer discretionary. So this ratio was at 54% at the height of 99 2000 bull run, and then it went down to as low as 26-27% from 55%, and this has now climbed back again to more than 50%. So this is a very real question for all of us. Are these valuations here to stand, or are we going to see yet another tech meltdown after an unprecedented tech bubble? Similarly, if you look at the global landscape, then all country world index today has the highest amount of valuations coming from tech and healthcare post the 99 2000 bull run. So that is at the highest since then. And if you look at financials and energy, they are at the lowest point in the last 26 years. So this just tells you that not only has this bull run been stunning, but the bull run in technology stocks has been beyond stunning. And apart from the heady days of late 90s, we have never seen this kind of a phenomenon ever before. This is again a pretty stunning fact, which many of you would find very, very surprising. The total inflows into global stocks in the year 2021 already exceeds the cumulative inflows of last 2 decades. So the total inflows this year in the stock market has been about $1.05 trillion, and this is more than the summation of total inflows into global stocks over the last 20 years. And this year has still not come to an end. So maybe by the time this year comes to an end, this figure can maybe go up to 1.3 trillion, 1.4 trillion. So this is not only the highest ever as a percentage of market capitalization, as a percentage of GDP, but in absolute sense, it is more than the summation of total inflows in last 20 years. This is how bullish the retail investors and the equity investors have been. And we have to ask ourselves whether this is sustainable or not. IPO market is absolutely booming. So whether it is the total amount of equity offerings or it is the number of IPO deals, both are at an all-time high. As you can see from the chart, this is much higher than at any point of time before, and the IPO market was doing extremely well in the year 99 2000 as well, but that pales into insignificance compared to where we are today. In fact, if you look at the total number of deals, today we are at 5 standard deviations above the mean. So this is how high the number of IPOs which are hitting the market all over the world. And probably if history is any guide, then this should be a warning sign to all of us that this situation is probably not sustainable for too long. Again, this is one part of the global economy and financial markets which has been absolutely stunning in its journey. If you look at just the last 4 years, the venture capital funding to startups has gone up by more than 4 times, and most of that rise has actually happened in the last 4 quarters. So actually, quarter, which is Q2 of 2021, this is the tallest ever, and this just gives you an understanding of the kind of boom that we have seen in the venture capital space. Venture capital includes the angel funding, it includes the early stage funding, it includes the late stage funding, and the growth stage funding. All of them are booming, and all of them are at record highs. So commodities are at a multi-year high, and in fact, they made a multi-year high only a few weeks back. But compared to S&P 500, commodities are at a 50-year low. So this just tells you how skewed the landscape is. While commodities are at a multi-year high, but the growth in equities has been so unprecedented over the last 10 to 12 years, and then particularly in the last 1.5 years, that commodity index as a percentage of S&P 500 is at a 50-year low. So precious metals, they have been far from precious. They do not feel like they are precious metals, particularly if you look at what has happened in the last 1 year. So gold did make a new all-time high in the year 2020, last year, August, but from that levels, it has corrected sharply. And as you can see from the screen, gold prices were compared to S&P 500, the ratio was about 1.65 in 2011, and that ratio is now less than 23% of what it was then. And today that ratio is 0.36, which is the lowest that we have seen in the last 16 years. So even though gold as an asset class has gone up in the last 16 years, in 2005, gold was at about $400, and today it is more than 4 times that price. But if you compare that with the rise in the financial assets, the S&P 500 and the equity indices of the world, then it just pales into insignificance. So this chart shows you how undervalued gold has become. So this chart compares the real interest rates in US. It compares that with the gold trajectory. So the real interest rates are inverted. So higher it goes, lower is the real interest rate. And if you can see, and as you can see from the chart, this is very directly and positively correlated to the gold prices. So basically, as the real interest rates have been coming down over the years, gold prices have been moving up. And in fact, real interest rates have been moving down pretty smartly for the last 20 years, and gold prices have also been moving up in the last 20 years. But over the last 1 to slightly more than 1 year, what has happened is that the real interest rates are today at a new all-time low. So in US, based on the inverse of US 10-year tips chart, we are at 1.13% of real interest rates. So real interest rates are negative to the tune of 1.13%, the lowest real interest rate ever and highest negative real interest rate ever. But gold is not at a new all-time high. In fact, gold, which has had a pretty mediocre run over the last 10 to 11 years as an asset class, has now slipped lower, and it is low by about 15 to 16% compared to the highs that it reached last year August. So there is a big disconnect between real interest rates and gold, and we expect that this is going to change over a period of time. This is another feature of the current boom. Baltic Dry index has gone up very sharply since 2019 to 2020. So you can see on your screen that Baltic Dry index is at the highest in many years. In fact, it is at about a 12-year high, and Baltic Dry index has gone up by almost 8 times in just last 1.5 years. So Baltic Dry index reflects the state of the shipping industry. Shipping industry is probably having its best time in many years, and the shipping rates have gone up so much in the last 1.5 years that they are at the highest of last 12 years. And in fact, the container freight benchmark rates have gone up by even more. So they have gone up by more like 10 times in last 1.5 years, and particularly the container shipment rates from Shanghai to Rotterdam, Shanghai to New York, they are at all-time highs. And this is basically reflective of the high costs that now traders and manufacturers have to spend to transport their goods from one part of the world to another. And this has also contributed to a very high inflation rate in the current economic scenario. So housing inflation in US is at a multi-year high. Rent inflation compared, even though rent inflation has also been positive, but compared to the rise in house prices, rental increases have been somewhat tepid. And in fact, house prices are at an all-time high in US and in most parts of the world. In US, compared to the house prices on an average that you had just at the peak of the housing boom in 2006-7, we are at 30 to 35% higher than that. And rest of the world is even higher compared to the 2007-8 prices. As you can see, median US new home price as a percentage of the US household income is at a all-time high, and this level is very high in US, and it is even higher in many other parts of the world. In fact, this has become a huge political issue in places like Australia, New Zealand, Canada, Germany, Sweden, where house prices have gone up so much that they have become unaffordable for people who are entering the workforce. So while house prices going up leads to a positive wealth impact for people who already own the houses, but for new entrants and for the youth who have just become employed, this has become a big thorny issue in so many parts of the world. So this talks about how accommodative the monetary policy has been in US. So the real Fed funds rate, so Fed funds rate right now is at about 0.1%, but the real Fed funds rate adjusted for inflation and adjusted for QE purchases is at about minus 5.5%. This is the lowest real Fed funds rate ever. So this just tells you how accommodative the policy has been. This red line that you can see is basically the real rate of interest that you can expect on a short-term basis if there is full employment in the economy. And that level of interest has come down in the last 60 years from about 4.5% to currently 0%. So as we mentioned before, real interest rates have been coming down for a very, very long time, particularly since the early 80s. Nominal and real rate of interest have been coming down very, very sharply. And the Fed funds rate, real Fed's funds rate, is at the lowest ever in history. So as we move to a monetary policy which is somewhat less accommodative than it is right now, of course, it would still remain accommodative. So even if real Fed funds rate becomes from minus 5.5 to minus 5 or minus 4.5, it would still be very accommodative, but incrementally, it would not add to the global GDP and the US GDP, because incrementally this would become a factor which is drawing strength away from the economy and not giving strength to the economy. So the investment grade bond spreads are at a multi-decade low. So this is not the lowest since post-COVID. This is actually at a multi-decade low. This is at the lowest since we have seen at least in the last 20 years. But actually, it is the lowest in much more than just the last 20 years. And similarly, this is for the investment grade bonds. Similarly, even for the high yield bonds, the interest rate spreads have come down a lot. US Financial Conditions Index, this is at 97, and this is at the best point ever. So the lower the financial conditions index, easier the financial conditions are. It just tells you how easily the funds are moving from one asset class to another and from one geography to another. So there is absolutely free flow of money in this world, and this is the financial conditions are at the loosest and the most accommodative ever in the history of capital markets. Bankruptcies, foreclosures, collections, delinquencies, all are at a multi year low. In fact, it is at a record low. And we have seen that every time there is a slowdown or a recession or a deep recession, every time that would happen, the foreclosures would go up because people would lose their incomes, people would lose their jobs, and asset prices would go down. So both because of falling incomes and because of falling wealth, you would see more of bankruptcies and more of delinquencies. But that has not yet started. And right now, the conditions are at their best ever. So now we come to the next part of the current boom phase, which speaks about the valuations. So Buffett indicator, which is basically MCAP upon GDP, is often used by a lot of investors to judge how pricey the markets have become. And this is again at an all-time high. This is at 140%. This is much higher than the level which was reached just before the great financial crisis. That time the level was about 120, and right now we are at 140. For US alone, this percentage is at about 200%, and for the whole world this is at 140%. This, in my opinion, are unsustainable valuations. which can probably last out for some more time, but they cannot last forever. And you would eventually have a phase where the valuations would come down from their current astronomical levels. So this is, of course, the price to sales metric. Again, we are at highest ever. So the previous big high that you can see for price to sales for US S&P 500 was at the height of the tech bull run, and that time, compared to that time, we are at much higher level today. We are at about 3.09 today, while at that time we were at 2.25. So price to sales is about 30 to 35% higher as a metric than it was at the peak of the IT bull run, and we saw what happened in the next few years post the peak of the IT bull run. And for Nasdaq 100, it is even more stunning. So this ratio is at about 5.64 times for the entire Nasdaq 100 index, which is higher than ever before. And in 2001 too, this ratio was at 4. So we are at 40% higher level compared to where we were in about 2001. This is again a pretty stunning chart. It talks about the same indicator price to sales, but here we have taken the technology stocks just to give you an idea as to how the valuations have hit the skies as far as the mainstream technology stocks in US are concerned. So Microsoft was not a minnow in 2011. But that time the price to sales was 3.1, and right now it is 13.1. So not only has the sales figure for Microsoft gone up a lot in the last 10 years because of the tech boom, because of this tech boom, particularly which has been unfolded by social media, e-commerce, and the smartphone boom. So not only have the sales gone up a lot, but price to sales is now at 4 times of what it was 10 years back. For Google, it has gone up by about 80%. For Apple, it has more than doubled. For Amazon, it has gone up by about 90%. And for Tesla, it has gone up from 14 times price to sales to 19 times. Now, what is to be appreciated is that the rise in sales that you have seen for all these corporations in the last 10 years is because of the revolution which unfolded in the last 12 years, which was social media, digital media, e-commerce, smartphone, and the electric vehicle revolution. So, normally, if history is any indication, the growth rate of these companies is going to taper down in the coming 10 years because the revolution has already unfolded to a large extent in the last 10 years. So, just like the sales growth of these companies went down drastically post the 99 2000 boom and remained under the weather for the next 7 years. Similarly, it is quite likely that the sales growth rate is now peaking out, and over the next 6 to 7 years, you would see a significant tapering down of the sales ratio. So not only could these same stocks, which have benefited by the rising sales growth, could not only lose out because of the falling sales growth rate, but in my opinion, the price to sales ratio, which is at absolutely unsustainable levels, that also has to come down. So price earning ratio, again, no surprise. We are close to all time highs. So the Schiller P ratio, which averages out the earnings for the last 10 years, is only slightly lower than where it was at the peak of the 99 2000 bull run. And as far as the normal P ratio is concerned, that went about as high as the 99 2000 level, and it has come down slightly. But the P ratios are today very high compared to any point of time in capitalistic history except for 99 2000. And just like these valuations were unsustainable in 99 2000 and markets fell by more than 50% over the next few years, we believe these valuations are unsustainable even now. So this talks about the earning yield of the S&P 500 stocks. So this is a very interesting chart, and what it shows is that the earning yield for S&P 500 stocks today is at 2.8%, which is the lowest earning yield in the last 100 years, more than 100 years, in fact. And this was matched only by the earning yield at the height of the tech bubble, which was also at 2.8%. And what you can see from the table, which is given in the lower half of the chart, at the 1929 peak, we were at 3.8 earning yield. And when the markets turned and the economy took a turn for the worse, the returns were negative for the next 5 years. And the returns over the next 5 years were at minus 74%. Similarly, 1937 peak returns were negative for the next 5 years. Similarly, the tech bubble, and the average for the peak is for the previous peaks of last 100 years is about 3.4%. And when you reach 3.4% on an average, what has happened is 28% cut in the markets next 1 year, 38% in 2 years, 53% in 3 years, and 49% cut in 5 years. We don't know what's going to happen over the next few years, but if history is any indication, this boom phase is probably nearing its end. And once things take a turn for the worse, you can expect the equity returns to be negative for next many years to come. So this is the next part of our current boom phase. This talks about the colossal debt overhang. So debt has been going up in the global economy, of course, since the since the recession post the 2000 peak, but particularly in the last 7 years, the situation has become extremely acute. And from debt levels of 210 trillion, we have reached total debt levels of 300 trillion all over the world. And debt to GDP ratio for the world, which was at about 310% 7 years back, and which was much lower. So this 310 was actually only, this was less than 200% in 2000, 2001. And from those levels, it has now come up to 355%. So the amount of debt overhang in the system makes us to believe that the next phase after this current boom phase is going to be deflationary, because when you have such astronomical debt levels in the economy, their companies and households, in order to pay their debt, would have to sell their assets. So asset values are going to come down, commodity prices are going to come down, which is going to probably result in disinflation or even negative inflation. And you would have washing away of the excesses of the system. And the excesses of the system are at their peak right now and still going up every single month, every single quarter. When this phase is followed by a deflationary phase, you would see the overall debt levels coming down, you would see the debt to GDP levels coming down, and you would see fallen as asset prices, what is normally the characteristic of any deflationary phase in the global economy. So if you talk about some of the major economies of the world, Japan is today at 400% debt to GDP, and the other major economies like US, China, and Euro area are at about 300%. So the overall ratio for the entire world is about 350%. And most of the advanced economies of the world are at more than 300% plus of total debt to GDP. So this talks about the public debt, which has reached unsustainable levels. So the public debt as a percentage of GDP has even crossed the peak of the Second World War. So at the peak of the Second World War, this ratio was at about 125%, and it has crossed this level in the post-COVID scenario. This just tells you how unsustainable this public debt has become. And one way or the other, this public debt has to become lesser as a percentage of global GDP. Central bank's balance sheet, again, no surprise, has been simply exploding. So central banks have been buying a lot of this debt, which has been issued by the central governments of the world. And they have been also buying debt because they want to make the monetary conditions easier. And they have been buying, for example, in US, they have been buying mortgage debt, they have been buying government debt to make the monetary conditions more and more easy. And in the process, central bank's balance sheet has simply exploded. So US is today at about, let's say, about $8 trillion. ECB is at about 9.5 trillion. Bank of Japan is at about 6.5, and PBOC is at about 6 trillion. So this just tells you how much this balance sheet has exploded over the last 14 years. And this also has implication when this money which has been printed, when this actually comes to drive the economy and comes to drive the prices, that is the time when you could have hyperinflation, and that is the time when commodities like gold and agro commodities could hit the roof. So the non-financial US corporate debt is again at an all-time high, and it is mainly issued through either loans or through corporate debentures and bonds. Both of them put together are at an all-time high, and they are at about $11 trillion plus. So while they have been going up consistently for the last 50 years, but particularly you can see that after the great financial crisis, corporate indebtedness in US has climbed a lot. So from a level of less than 4 trillion, the debt securities liability has almost doubled to 7.4 trillion. So the CDOs and the CLOs of the US housing sector in the great financial crisis has only been replaced by CDOs and CLOs of the US corporate sector. So while the US households are not as leveraged as they were that time as a percentage of their annual income, but US corporate sector is indebted to a much greater extent. And whenever this boom phase gives way to a deflationary phase, you would find many corporates in trouble. So this is the next part of our current boom phase, which talks about the current inflation. So while inflation has gone up a lot, but what we believe is that inflation has gone up mainly because of the low base effect of last year. So last year, as you would know, all commodity prices had gone down a lot, and commodity index was at its lowest of many years, and there was negative rate of inflation in large parts of the world because of the fact that we are comparing the current inflation with those low base quarters and months. Today the inflation seems to be very high. So if we talk about the Fed's main price index, which is called PCE, personal consumption expenditure, that level, absolute level, is 4.2. On a core basis it is 3.6. But if you look at the trimmed mean PC inflation, which is when you take out the extreme commodities and extreme in extreme points which are sort of much lower than mean or much higher than mean. So if you take out the extremes from both the sides in the CPI index, then it is called trimmed mean PCE, and that you can see is a relatively flat line, and even now it is at 2%. So this indicator suggests that the inflation is going to be transitory, and this inflation is not going to become into a next hyperinflationary phase. So this is the inflation rates of some of the supply constrained categories in US, like new cars, used cars, rental cars, sports and recreational vehicles, sporting equipment, furniture, housing appliances. So these are some of the parts of the consumer index which are today extremely high. They are all showing double-digit inflation figures, which is because there is constraint in their supplies. But as we speak, those constraints are becoming easier, and as per this Goldman Sachs prediction, all these supply constraint categories are going to cause deflation or disinflation in the next 1.5 years, because they are all going to be in minus in the next 1.5 years. So again, this metric helps us to infer that the current high inflation rate is unsustainable, and this is only a transitory phase. This is also a base case for the Fed, and we believe that this inflation figure is going to come down over the next 1.5 years. So this talks about the manufacturing and supplier delivery times. So as you can see, this went up a lot in the last 1.5 years, and as the as you saw in the previous chart, some of the categories are going through a supplier constraint. So the manufacturing and supplier delivery times have gone up a lot in the last 1.5 years, but it has already begun to come down. And you can see from this chart, in the last 70 years, whenever supplier delivery times have gone to a peak, and when they correct from that level, usually what results is a much lower inflation figure, or in fact a disinflation figure. And we believe that same thing is going to happen this time around as well. So this is now where we suggest that the peaking out is imminent for the current boom phase. And here we have many metrics which all suggest that peaking out is rather imminent. So the global credit impulse, which is a leading sign for the global GDP, that you can see has already come into negative. So this helps us to believe that this boom phase is on its last legs, and the monetary conditions are no longer conducive for very high growth rates, and this boom phase is probably on its last legs. So the risk premium on the Asian high yield dollar notes is at a very high level compared to where it was in the previous few months. So this made its low level at about 4.5%. This is the difference between the high yield Asian dollar notes and the investment grade peers, and this has already climbed to 8%. This is again a leading sign that the financial conditions are no longer so easy, and things are probably going to change for the worse. Similarly, for the triple C and B rated bonds, you can see that the bond yields bottomed out a few months back, and they are no longer making new 52-week lows. If you look at the economic surprise index, then Citigroup economic surprise index for the G10 economies is already in negative, which means that economic data is not going to be so favorable in the time to come. And economic data is already not surprising economists on the higher side, rather it is disappointing economists. So this is a big change that has happened in the last few months, and this is again an example of the same statement that we made, that the boom phase is probably on its last legs. For the emerging economies, this has also come down very sharply in the last few months and is on the verge of going into negative territory. PMIs again have peaked out. For the advanced economies, they peaked out in about 3-4 months back between March and June, and they have been trending down. And for the emerging economies, in fact, they peaked out last year between November, December, and they have been consistently going down. In fact, they are below 50, which means that emerging economies PMIs are no longer in an expansion phase. They are basically in a contractionary phase. Homebuilder Sentiment Index has also taken a tumble in the last few weeks, and after making a new high, a new all-time high, this even made a higher high than the high made at the peak of the housing boom in 2006. This has come down, and this is again a leading indicator that probably housing, which is a mainstay for the US economy, is probably going to face tougher times in the near future. and the easy conditions of the past are probably going to taper down. Consumer sentiment index has also come down. So we are now at levels which are no longer commensurate with the boom phases. We have come down very sharply. So in the post-COVID, the highest level that this particular sentiment index went to was at about 88, and right now we are at 70. And consumer sentiment is again a leading indicator, and that tells us that consumer buying and retail spending is probably not going to be so buoyant as it was. So this is again a leading indicator. This is the spread between University of Michigan and Conference Board Consumer Sentiment Index. And whenever this index has gone to higher levels compared to the recent past, this has in a way predicted the next slowdown. So this index was this difference between these two different indices. What it is was at its highest in 99, and you had this recession post that. Then it was at its high in 2007, and you had a recession post that. It again made a high pre-COVID, and we got the COVID recession, and it has come up to a very very high level, and this will probably give way to another fall, which would in a way be tantamount to the boom phase coming to an end. Margin debt in US is at an unsustainably high level. This has gone up a lot in the last few years, and particularly this year, the change compared to last year has been the highest ever. So this is an unsustainable level, and it has already begun to come down. So we believe that this is also a leading sign that the markets are going to be less buoyant than they have been in the recent past, and the boom phase is probably going to peter out. US households equity exposure, you can see, has been going up, and whenever it has made a sharp peak in the last 50 to 70 years, it has basically led to the next slowdown. It has led to the next markdown in the financial assets. It happened in 1970, and you got a very sharp cut in the financial assets, and you got a very sharp cut in the equities. They went down by about 45%. It happened in 2000, and equities went down by 50%. This time, this ratio is at an all-time high at about 36.5%. And we believe that this is again a sign that the times ahead are not as rosy as the times gone by. So correlation between growth and value is at 0.4. The last time the correlation between growth and value in US S&P 500 was at levels close to these levels was in 99 2000, and that was followed by the tech bubble burst. This time again the conditions are similar, and you've got this tech bubble part 2 in our opinion, and we believe that this is also going to be followed by a sharp fall in the equity prices. So emerging markets index actually peaked out in February of this year, and this could again be a leading index which has come off its peak this year, and maybe the other indices are a lagging indicator, and they may come also off their highs in the months to come. Some of the hot investment themes like clean energy, SPAC, IPO, they have all peaked out in the first quarter of this year, and they are all considerably down from those high levels. So we have reason to believe that just like these very engaging themes of the 2021 bull run have peaked out, similarly S&P 500, NASDAQ, and the global equity indices also may peak out pretty soon. So we have now come to the end of this chapter of our presentation, which was the boom phase. And this tells us that the valuations are unsustainable, that the boom phase is on its way out, it is on its last legs. It tells us that in a way, this particular boom phase should not be looked at in isolation. we should not look at this as just a 1.5 year boom phase. This should be looked at as a 12-year boom phase that started in 2009-10 post the great financial crisis, and the post COVID cut in the economy and the financial markets was just an aberration. So in a way, this is a much longer boom phase. And if this boom phase is on its last legs, the next pertinent question is what is going to happen to the equity markets? So if we believe that the boom phase may still have another 6 to 8 months or 10 months to run, because there is still enough momentum in the global economy which can probably cause this boom phase not to peter out so quickly. But then we must remember that financial markets are forward looking, and financial markets would peak out a good 6 to 8 months before the boom phase actually peters out. So this is our conclusion, that the boom phase is probably going to last maybe up to the middle of next year 2022, but the financial markets are probably going to peak out, and we've seen some parts of the financial markets peaking out over the last few months. Iron ore, if you look at it, is down more than 50% from its highest of this year. And similarly, we've shown you many indicators which are significantly lower than where they were in the beginning of this year. So in our opinion, financial markets being forward looking have already started discounting the fact that this boom phase is on its last legs. So what's going to happen after this boom phase? That is what we expect is going to unfold between 2022 and beyond, which is the next deflationary phase. And what happens in a deflationary phase, to showcase that, we will share with you what has happened in the previous deflationary phases post some of the great booms. So post the 99 2000 boom, you had the deflationary cycle of 2001-2, where you can see that S&P fell by 49%, gold rose by 49%, US 10-year bond yields went down by 52%. Then in the next deflationary cycle of 2008-9, which was the great financial crisis, S&P 500 moved down by 56%, gold went up by 70%, and US 10-year bond yield went down by 61%. Then the next deflationary cycle of 2015-16, which was a very, very short deflationary cycle, which was unleashed by the China devaluation of yuan, S&P fell only by 13%, gold rose by 30%, and US bond yields, 10-year bond yields fell by 48%. So this is what you can expect from a deflationary phase. This time around, we believe the deflationary phase is going to be longer because the debt overhang is significant. It is significantly higher than the previous deflationary phases of 2015 or 2008-9 or 2001. So this time, because the debt is significantly higher, we believe the deflationary phase also would end up being more sinister. It would result in sharper moves down in equities. It would sustain the equities at a lower level. It would result in a bigger climb up in gold. So, and this would be longer lasting than the previous deflationary phases. In our opinion, this could be a 3-year long deflationary phase between 2022 and 2025. So next we come to the last phase, which is the hyperinflationary phase, which we expect will unfold post 2025, because central banks will keep pumping in money into the economy. They will keep fighting the deflationary phase with more and more money pumping in, which will eventually result in a hyperinflationary phase. And we want to showcase what happens in a hyperinflationary phase by sharing with you what happened between 1970 to 80. So in that time, S&P 500, in the first couple of years of the hyperinflationary phase, it went down by 48%. US 10-year bond yields went up by 91% in that time frame. Silver went up by an astronomical 3,751%, and gold went up by an astronomical 2,277%. We do not expect that gold and silver would do as well this time in a hyperinflationary phase, because they had been kept unnaturally low because of the post-deflation diktat in US that nobody could own gold. So when we came off the gold standard, then suddenly this bull run was unleashed and you got hyperinflation and you had gold and silver outperforming. This time again, gold and silver will go up a lot, but probably not as much as they did in the 1970s. So this is what we expect is going to happen in the global economy. The boom phase will last till probably the middle of next year. Deflationary phase will last from 2022 to 2025. Hyperinflationary phase will last from 2025 to 2029. As our strategy, we will keep bringing down the equity positions that we have in the remaining of the boom phase, because as we mentioned before, markets being forward looking, they would start going down much before the boom phase actually comes to an end. In deflationary phase, we would accumulate just at the beginning of the deflationary phase, we'll accumulate gold and we will accumulate US long-term treasuries because they will perform very well in the deflationary phase. And gold is the only asset class, gold and silver, the precious metals, which will do well both in the deflationary phase and the hyperinflationary phase, because your treasuries, which will do well in deflationary phase, will actually underperform in hyperinflationary phase, as we saw happened in the 1970s. But gold is one asset class, and silver probably will sort of also go up with gold, maybe to a lesser extent, which will do well in the deflationary phase and it will do very well in the hyperinflationary phase as well. So now we come to the last part of our presentation, which is the a small section that we have on Indian markets, and we want to showcase what has happened in the Indian markets while there was a boom in the global markets. How have Indian markets fared vis-a-vis the global markets? And no surprises here. Probably all of you already know that Indian markets have outperformed most of the equity markets in the world, and the benchmark index for the Indian market, which is the MSCI emerging market, Indian market has outdone that by a mile. So in the last 10 years, you can see that emerging market index has gone up by only 26%, while in the same duration, MSCI India has gone up by 200%. Now, in the last 1 year alone, you can see a massive outperformance by MSCI India compared to MSCI EM. We have gone up by 19%, while we have gone up by 51%, while MSCI emerging market has gone up by only 19%. So our bull run has been even more spectacular than the rest of the world, which has also been, I would say, a pleasant surprise. But Indian markets have been completely stunning compared to the rest of the world. So this is where our valuations stand. So we are at 31.6 times the current EPS. We are at 23.4 times the future EPS for the next 1 year. And you can see that we are, in terms of our projected P, we are at the highest compared to all the other benchmark markets of the world, which include US, Indonesia, Japan, Taiwan, Brazil, Russia. So compared to US, we are more expensive by 4%. And just remember that we have just made a case that US markets are at an unsustainably high valuations, and Indian markets are at even higher valuations than US. Compared to Russia, we are overvalued by about 74%. If I take projected P as the metric for overvaluation, compared to MSCI emerging market, we are 42% more expensive. So this is how expensive we are relative to the world. And if the whole world is expensive and if the whole world is to go down, then there is no doubt that Indian markets would also go down. But we are probably even more overstretched than most parts of the world. So in our opinion, whenever the bear phase unfolds, our markets could in fact underperform many of the other top indices in the world. So this is one metric which tells you about how the 2-year forward P multiple has moved for Nifty 50. So whenever it has gone up one standard deviation away from the mean, like it did in 2007-8, you saw a sharp correction. Whenever it did that between 2016 and 2019, every time there was a sharp correction. Of course, in 2020 post COVID, we saw a very, very deep correction in India. But now, here is the surprise. This 2-year forward P multiple for the first time is now at 2 standard deviations away from the mean, which it has never done before. So, if 1 standard deviation away from the mean has resulted in sharp corrections, one can only imagine what could happen when this boom phase comes to an end and financial markets start discounting the end of the boom phase. What could happen to the Indian markets this time around? So, with this, we come to the end of today's presentation. I thank you so much for your time and attention. And now I hand over the proceedings back to Kanika for the Q&A. Thank you so much.
Thank you, Amit, for this insightful presentation. We are now open for the Q&A. And our first question is by Mr. Chaitanya Arora. In fact, Mr. Chaitanya has asked us 2 questions. The first one is, what is your view on the future of the fiat currencies? And the second one is, what's the view on cryptocurrencies, speculation or replacement of fiat?
Thank you so much, Chaitanya. That's a very, very pertinent question. So, as we have mentioned in our presentation, post the deflationary phase, there is going to be a hyperinflationary phase. And in that hyperinflationary phase, fiat currencies could lose their value dramatically. And when we are talking about fiat currencies, we are talking about all fiat currencies, whether it is dollar or it is euro or it is yen or it is INR or any other emerging currency of the world, including yuan. So when so much of the excesses, when so many excesses are going on, when we are incessantly printing money and the central banks of the world are abusing the privilege which they got in the 70s, when currencies came off the gold standard and you could literally print your currency to any level without the need to have enough gold reserves with the central bank to print those currencies. Now that the privilege has been abused to such an extent, we believe that this will result in a very, very severe hyperinflationary phase. And I would not be surprised if the fiat currencies lose about 80 to 90% of their value in that hyperinflationary phase. We have seen this happening in some parts of the world before. We saw that happening in Weimar Republic, the post World War I Germany, when the currency lost more than 90% of its value post the World War I because of the reparations which Germany had to make to the rest of the world. So we believe that almost all the fiat currencies of the world could be on a similar trajectory in the hyperinflationary phase. In the deflationary phase, currencies are not going to lose value because there is going to be deflation. So probably anybody who has the same amount of money would be able to retain their purchasing power during the deflationary phase. And this particularly applies to the advanced economies of the world, not necessarily to the emerging economies of the world, which, because of their own devaluation against dollar, may face not deflation, but somewhat higher inflation compared to the developed world. But the fiat currencies are essentially going to lose their value during the hyperinflationary phase. And this would include all the developed and all the emerging currencies of the world. Now, the next part of your question, which is the cryptocurrencies, we are not very gung-ho on cryptocurrencies, and we believe that cryptocurrencies are actually a bubble. And we believe that cryptocurrencies do not really have any economic value in them in the long term. There are thousands and thousands of cryptocurrencies, and even the staunchest of cryptocurrency bulls today are not, they cannot be 100% sure that if cryptocurrencies are to stay alive, which one will thrive the most, whether it's going to be Bitcoin or Ethereum or Cardano or something else. In our opinion, cryptocurrencies do not have an economic value, and we believe that over the rest of this decade, cryptocurrencies are going to come down, and many of the cryptocurrencies will probably become zero. And even the most successful of cryptocurrencies may not be able to retain their current value and may come down a lot. Thank you so much, Chaitanya, for the question.
Thank you, Amit. Our next question is by Ms. Divya Mita. And the question is, can you tell some short-term profitable stocks?
Right. So, see, we are a macro top-down researcher and asset management institution. So, we do not necessarily go into individual stocks. We normally confine ourselves to stock indices and sub-indices and not to individual stocks. But going forward, what we do believe is that some of the FMCG companies will probably do well, but only once they have seen a sharp correction. So once they have seen a sharp correction, you could see a climb up in them. I would not like to take the names of individual FMCG stocks, but I believe because of the fact that aggressive stocks like industrials, like financials, will probably take a deeper hit. So the defensive areas of the market will do better. And particularly in case of Indian stocks, we believe that some of the textile companies could do well because we believe that for the next few years, the textile exports from India are going to go up. The regime globally is going to be more favorable to India going forward. And with the advantages of the currency depreciation and with the advantages of some of the incentives which the Indian government is unfolding across different sectors, we believe that some of the textile companies could do very well. But again, I would not take the names of individual stocks, and you could probably be in touch with our research team over the next few days, and we can probably go into more details on a one-on-one basis with you. Thank you so much, Divya.
Thank you, Amit. Our next question is by Mr. Vedant from Bangalore. And the question is, what is your view on startups and should one be investing in the space?
Thank you, Vedant. So, startups, of course, have been absolutely at the apex of this bull run of last 10 years. And as we saw in our presentation, last few quarters and last few years have been particularly very kind to the startup space, whether it is angel funding or it is early stage funding or late stage funding or growth funding. Startups, venture capital, private equity have done very well. Now we believe this space presents an asymmetrical risk return profile wherein the potential return is not very high because they are absolutely standing at a valuation which seems to be unsustainable to us. And you know that many of the hype startups, when they actually got listed in the US markets, they actually listed at a lower valuation than the peak valuations which they saw as a startup. So this is a sign of the times. We believe that the best phase of the venture capital is probably either behind us or is going to be behind us over the next few months and quarters. So I would wholeheartedly recommend that we prune down our weightages and our investments in the startup space, and we bring it down because this time around the level of depreciation in the startup valuations could be rather sharp. You saw that happening post the tech bubble of 99 2000, where 99% of these startups went down to zero. And we believe that we could see a similar phenomenon this time around as well. So I would be very wary of this space going forward. Thank you so much.
Thank you, Amit. Our next question is from Mr. Corner from Germany. And the question is, what is your view on gold and how long should one hold it for optimal returns?
Wow, thank you, Mr. Corner. That's a question which is close to my heart because gold is an asset class which is one of our favorite asset classes. As we just saw in our presentation, this is the only asset class which would do well in both a deflationary phase and a hyperinflationary phase. So we believe that gold has already made its bottom when it went down to $1,670 in March to April of this year. We do not see that price going again in the next few months or quarters. We believe the bottom has been made, and we are of the opinion that gold will do extremely well in the ensuing deflationary phase. My best guess is that between now and 2025, gold could go up by 150 to 200%. And then it would again go up by maybe 2 to 3 or 4 times in the hyperinflationary phase. So I believe that for the rest of this decade, gold is our chosen asset class, and this could go up by anything from 5 to 7 times over the next 8 to 9 years. So we are extremely, extremely bullish on gold. Thank you.
Thank you, Amit. Our next question is by Mr. Steven from Singapore. And the question is, where do you see the dollar index going over the next 2 to 3 years?
Right. Thank you so much for this question, Stephen. So what we believe is that US dollar is actually going to depreciate over a period of time. This we believe is because of a couple of factors. One, there are 8-year cycles in dollar versus the other developed currencies of the world. And we saw the euro bullish cycle coming to an end in 2008. And we believe that dollar peaked out in 2000 and early 2017 when it went up to about 103, $104 index levels. Currently, the dollar index is about 92. So 10% depreciation has already happened in dollar index over the last 4 years. And we believe that over the next 4 years, more depreciation is going to unfold. One, because dollar is overall in a devaluation cycle compared to euro, and of course compared to the other European currencies. And secondly, because of the twin deficits which US has, US has got the highest current account deficits. It is the biggest debtor country in the world, and US is also one of the highest fiscal deficits in the developed world. Because of these twin deficits, dollar is going to depreciate over a period of time. However, there is a small caveat. If equity markets take a sharp tumble over the next few months, we should not be surprised to see dollar index going up even further. So maybe from 92, it could go up to 94 or 95. It will probably not go anywhere close to its 2017 high, but it could go 2, 3, 4% higher. But overall, over the next few years, we would expect dollar index to go down and dollar to go down against euro and Swiss franc. Thank you so much.
Thank you, Amit. Our next question is by Miss Williams from New York. And the question is, why is the boom phase going to last just 2 years this time around?
So thank you, Ms. Williams. So as I mentioned before in my presentation, this boom phase should not be looked at as just a 1.5-year phase since March of 2020. In my opinion, this should be looked at as a 12-year phase which started after the great financial crisis and the great financial recession of the 2008-9. So this was the longest boom in the history of US. Before there was this COVID recession, which was obviously triggered by COVID. It had got much less to do with the global economy and much less to do with the financial markets. I would see that period as an aberration. And I believe that this is now an 11.5 or 12-year boom and not just a 1.5-year boom, which is why this boom would not last out the normal duration of a boom, which on an average has been about 5 to 6 years in the last 70 to 80 years post Second World War. We believe this boom phase is going to last about 2 years. from 2020 middle to about 2022 middle. So this is our best expectation for how long this boom phase is going to last. And this is the reason why this is probably not going to last till 2025-26. This is just the extension of the previous boom. We did not see the restructuring. We did not see the washing away of the excesses the way we should in a normal recession. So this could have become a normal recession had it not been for the intervention of the central banks and the governments. But this never became a normal recession. There was no restructuring, no washing away of the excesses. And we believe that this is just an extension and it will probably peter out sometime from the middle of next year. Thank you.
Thank you, Amit. Our next question is by Mr. Smith from UAE. And the question is, how will industrial commodities perform in the hyperinflationary phase?
Wow. Thank you so much for this question. So we do believe that all commodities are going to go up in the hyperinflationary phase. But there is an important distinction that I would want to make here. Hyperinflationary phase would also mean stagflation. So on one hand, inflation will be going up, but on the other hand, GDP would be coming down. So you would be having a contractionary economy because of which the demand for commodities is actually go down and not up. So on one hand, demand for for commodities would go down, but on the other hand, fiat currencies would be losing their value, and they could probably lose 90% of their value. So an average commodity could go up by maybe about 3 times or 4 times in this hyperinflationary phase. But gold and agro commodities will be ones which will not have a demand contraction, and gold will actually have a demand expansion because a lot of money would actually want to get into this narrow asset class, which is just about worth $11 trillion today. And you have got financial assets which are worth about $300 trillion. So when too much of money wants to go into gold, you would see demand for gold going up and fiat currency is going down, because of which gold could just explode many times. But your normal industrial commodities would go up by maybe 3 or 4 times. But I would want to reiterate that all commodities would go up. Thank you so much.
Thank you, Amit. Dear participants, this is the last question of the session. The question is by Mr. Rajiv. If most central banks are printing money, won't their currency devaluations of all those kind of mitigate the relative impact?
Wow. Thank you so much, Rajiv. I think this is an often misunderstood aspect of devaluation. So while you are absolutely right that some currencies would go up against the other, for example, I would expect that in the hyperinflationary phase, currencies like euro and Swiss franc would do a lot better than currencies like dollar. So euro, which is right now at, let's say, about 1.17 to a dollar, it could easily go up to 2 times to a dollar. But that would not mean that that euro would not lose ground against commodities. So all that it means is that euro gets revalued against dollar and dollar gets devalued against euro. But both will go down against a bunch of commodities. So let's say if dollar loses 90% of its value, it is quite probable if euro goes up against dollar, instead of losing 90% of its value, it will lose 50% of its value. So commodities which go up by 4 times against dollar, it is possible will go up only 2 times or 2.5 times against euro. But it would not mean that commodities would not go up against these currencies. So all fiat currencies will come down, in our opinion. Some will come down more, some will come down less. The ones which come down more will go higher against the other currencies, but will still lose their value against commodities. And all currencies will lose purchasing power, which means that even if you are left holding the best currency in the world, let's say the best currency in the world turns out to be Swiss franc, and if you are left holding the best currency of the world in the hyperinflationary phase, you could still lose 60 to 70% of your wealth. You would probably lose less than what the people who have been left holding dollar are going to lose. But you would still lose 50 to 60 or 70% of your wealth if you are left holding the currency. So all currencies will lose value. Some will lose less, some will lose more. Thank you so much, Rajiv, for this question. And
And
thank you
thank you
so
so
much,
much,
all
all
our
our
participants,
participants,
for
for
your
your
time and
time and
attention.
attention.
We
We
really
really
value
value
this
this
opportunity, and
opportunity,
we are
and we are
grateful to
grateful
you
to
for
you
giving
for
us
giving
this
us.
opportunity. Thank you
Thank
so
you.
much.
Thank you, Amit, and all our participants for this interactive Q&A session. For the participants whose questions couldn't be answered due to paucity of time, please be rest assured our best of the responses shall be wired into your respective inboxes. We'll be glad to have your valuable feedback. To share your feedback with us, please use the Q&A panel, which has the feedback link. Just click on the feedback link, fill up the feedback questionnaire, type your name, location, and click on the submit button to share your feedback with us. That brings us to the end. We sincerely appreciate your valuable time and making this webinar a success. We shall look forward to your participation in our upcoming webinars as well. We shall keep you posted. Thank you and have a nice day ahead.
Thank you, everybody.